John, good to see you again. Got another question for me? Yeah, I've been getting into rental real estate lately, and I was wondering if you had any tax advice for me. I do indeed. First, do you plan to actively participate in the rentals? What does that mean? Are you going to be involved in the day-to-day operations and management? Not sure yet. What difference would that make? If you are actively participating, you can take any non-passive losses on Schedule E. If you are simply the owner and not very involved, the activity would be considered passive and losses would get limited and carried forward to offset future income. How do I know for sure if it's active or passive? The IRS has tests for that, including an hours test and a significant participation test. I should also mention that meeting certain criteria might mean you are a real estate professional, which would allow you to treat all of your rental activities as non-passive, regardless of how involved you are. But that's not easy to do. Okay, so what exactly should I do to make sure I meet non-passive status? Keep good records of the time you spent on each property, how much maintenance you performed, and all the important decisions you made. Are there any advantages to passive income? You may be eligible for the passive activity loss deduction. This would allow you to offset passive losses against passive income. Beyond that, not really. And what about reporting? When filing your 1040, your rental income and expenses will go on Schedule E, page 1. Other forms could come into play, but that is the major one to keep in mind. What if I wanted to buy, fix up, and sell rental properties? Would that activity also go on Schedule E? In that case, Schedule E wouldn't come into play at all, only Schedule D. Would that be a good way to avoid paying taxes? If you held the properties for more than a year and sold them for a gain, it would lessen the tax due. In that case, you would be using long-term capital gains tax rates, which are generally lower than the ordinary income tax rates. Yes, that's exactly what. However, I should probably mention that your real estate taxes on these investment properties are going to be higher than a personal residence. Why? Because the properties would not qualify for the Michigan personal residence exemption. What is that? It is an exemption of the tax levied by your local school district, up to 18 mills. You avoid this when the property is your primary residence. Well, that's annoying. Very, but it's how things work. I'm glad you brought it up. So, you got places to be? Of course. You? Of course.